I'm in the process of converting my NinjaTrader 7 scripts to NinjaTrader 8. And this process gives me an opportunity to do some deep analysis. And I'll take a look at Cobra 3, which trades the stock index futures. Look at the E-mini S&P, look at the report. This goes back, the most data I have in NinjaTrader generates trades back to July of 2006, so about 10 years. You see the total net profit, 897 trades, 57.43 average trade profit, 29.50 drawdown. This is Cobra 3, and it's on 15-minute charts. And we'll take a look at the equity curve. You see the first trade here is 7/19/2006. You can move this equity curve up so you can take a look at it. There are the results of the equity curve. Nice curve right here. This is a strategy that was originally in Cobra Trade. This is a strategy that was originally on 5-minute charts, and we've taken a look at different time frames. But I want to do an analysis of slippage in commission. So we take a look at 57.43 per contract, average trade profit. That is filling limit orders when touched and not using slippage in commission. And so we look at the most optimistic view, and then we'll take a look at the most pessimistic view from a fill perspective. And in NinjaTrader, you can go format strategies, right click on your chart, and take a look here at the inputs. This input right here, fill limit orders on touch. In NinjaTrader 7 we had different fill types. We had default and we had liberal with open is what we used. This is similar to liberal with open, and when I uncheck this, it'll be similar to default. And so I'm going to disable it, apply that, and then I'm going to take this off, and I'm going to select enabled, and that will allow me to check what this performance report looks like if we don't show a fill unless the price trades through the limit. And so we know that we got filled for sure. And this strategy has a limit order on the entry, has a stop loss, a profit target, or it gets out on the close at 4 o'clock p.m. Eastern Time. We send a market order if it's still in the strategy to get out. And so the way we manage this in real time is we have this option right here to cancel and replace the entry orders to the market, or cancel and replace the profit target orders to the market. We enable that. After, you can change the number of seconds from 0 to 3 to 15 seconds. And so if we want to implement this strategy where we fill the limit orders with touch, we also want to cancel and replace entry to market. This is only effective during automation. This doesn't affect the back test. So I had it unchecked, but that only affects the automation, not the back testing. So now we're going to take a look at the back test, where if we implemented it, we would leave these unchecked. So for back testing purposes, it doesn't matter whether you have this checked or not. But if you want to implement the fill limit orders on touch, you would check these to cancel and replace them. So make sure you got filled. And if you're using if you uncheck this box, which means you're using the old default method from NinjaTrader, it would mean that you leave these unchecked during automation, so that the price you have to require the limit order to be filled. And so we're going to take a look at the difference between the performance summaries and the average trade profit when we look at whether we report a fill, whether it's touched, or wait for it to trade through the price on the back test. I'm going to apply this. It's going to take a little bit of time here. One of the caveats of doing this is the fact that you don't know for sure. You're never 100% sure. We looked at the most optimistic results, and when you fill the limit orders on touch and then cancel and replace to the market, and you always know you're actually going to be in that trade, and you're going to have slippage, but you know you're going to be in that trade. But when you back test it with this unchecked, you don't know whether it got filled or not. I mean, you know in live trading whether it got filled or not, but you don't know in the back test whether it would have gotten filled in live trading, because sometimes it gets filled when the limit order is placed, and it does not trade through the price, through your limit order, it can get filled in live trading. So you can get better results in live trading than your backtest because it may not trade through that price, and it may report a fill, which means it'll be a profitable trade because it never went against you. It got filled right at that price. It's a rare occurrence. So we kind of look at the difference between the most optimistic and most pessimistic viewpoints. And so now let's take a look at the performance. And so you see about $15,000 in difference, and a lot of that has to do with the number of trades. Well, actually, there's only 30. There's 897 trades versus 867 trades. The average trade goes down by $15. $57.43 versus $42.55. And so there are the differences in results. Let's look at the equity curve. This is the equity curve. On the right is the equity curve of filling the limit when the price touches your entry order, and this is the result of waiting for the price to trade through the limit. And so you can average somewhere between these results, and we're still looking at these without slippage, without commission. And so I want to take a look at what the results would be if you applied slippage, additional slippage and commission for the stop orders and market orders on this strategy. So how do we do that? How do we go about analyzing this? We make sure that we don't get any slippage on the entry because we required the limit orders to be filled. We require that the price to trade through the limit in order to be filled. And so we know in live trading that we would not get slippage on the entry and on profit targets. We would take a look at the trades. Let's look at the trades. One of the things you can do is you can export this to a file. You can go to the trades, you can right click and you can export this, and you can send that to a file, and I did that on this NinjaTrader grid. I already did some of these calculations, so I'm going to show you the results of that. So here's the spreadsheet. I opened it up. Here are all the trades, 867 trades. You have your entry price, your exit price, your entry name, your exit name. And what I did is I added these three columns so I could sum up each of the time exits, the stop exits, and the target exit. So if this was a time if this one or this one, if this one was a time long exit or time short exit, then I just put a 1 here so I can add it up. If it was a stop exit, long or short, it's a 1 here. If it's a target exit, long or short, I put a 1 there. And you can see the formulas here that I used at the top. And this way I was able to sum up all the time exits in this column. I click on this and you can see the total down here, 436 time exits. If you click on this column, you see the total, 305 stop exits. And if you click on this column, you see 126 target. It hits the profit target 126 times. And so 126, 305, and 436. And then I went to this sheet, and the time exits 436, the stop exits 305, and 126 target exits. And there's 867 total entries, which means you have 1,734 total trades. And so what I did over here is I looked at the slippage, and I said that if on time exits, we're just going to say 100% of the time exits get slippage of 1 tick. And so 1250 times 436, that means $5,450, which means that this is a pessimistic view because you're not going to get, sometimes occasionally you'll get 2 ticks of slippage or maybe more, but sometimes you won't get any slippage. So I think counting 1 tick on every trade for a time exit where you send a market order at 4 o'clock is fairly pessimistic. close to the right number and fairly pessimistic because you're not going to get slippage on every trade that you do that. Sometimes you'll get at the price or negative slippage. On the stop exits, there's 305, and what we did there is we said half of those will get slippage, which I think is pessimistic. So many times on stop orders in liquid markets, you get filled at the price. That's the plus side of a losing trade, if you can say that, is that a lot of times on losing trades you have stop orders, and in liquid markets like bonds or E-mini S&Ps, you don't get slippage, but sometimes you do, and so we'll just say half the time you get slippage. So we take 152.5 trades, multiply it times 1250, and that's your total slippage. The target exits, no slippage. The entries, no slippage because we're waiting for the price to get filled. And so you take these numbers and you total them up. That's $7,356.25 additional slippage. And then you divide that by 867 trades, and you come out with this number as your average slippage per round turn. This is a slippage per round turn. If you take out these numbers, if you go in and take these numbers and average them over time, $8.48 slippage because you're waiting for your entries to get filled at the limit, you're waiting for your profit targets to get filled at the limit, and you made this analysis that you get slippage on every time exit and you get slippage on half the stop exits, $8.48, and then if you add about $5 for commission, you get $13.50 for round turn slippage and commission on a strategy like this that's waiting for your limit orders to trade through. And so what you have here is, let's take a look, $13.50, remember that number, and then you go back to your summary and you say $42.55 minus $13.50, $29 average trade profit is what you get. And so that's still a good day trade number if you can get $29. I like to get $50 when we're talking about a strategy that does that gets filled when the limit order touches the price and without slippage and commission. At the most optimistic view, for example on this one, I like $50. I like to have $50. But if you're having the limit orders trade through the price to report a fill, then you can have a lower number, and then when you take out slippage and commission, if you have $29, that's still a very good number for a day trade strategy. The only thing I would like to see more in this, if possible, would be if we could take more trades. And so on this one, how do we analyze this? I typically take out $25 to $30 on average when I take a look at this, and if you take out $28 on this, you're basically getting $29 average trade profit as well. And so when you, it kind of works out the same. If you, over time is my analysis, if you wait for the limit orders to get filled, or if you cancel and replace them at the market, it ends up being about $25 to $30 slippage and commission off of the most optimistic result, and that typically ends up matching the slippage and commission on the most pessimistic fill type result. And so they end up matching over time, and I've done this analysis over and over again, and it's about the same. So you can wait for your limit orders to get filled, or you can know they're filled. I prefer to know that they're filled and take the extra slippage and commission, but knowing that you don't miss any winners. And so that's the one issue of this strategy. You missed 30 trades, and I haven't gone in to see which one those are, but those are winners if they don't ever trade through the limit. If they trade at the price but not the limit, you miss 30 trades, and that can make a pretty big difference over time, and you can see that number, but you do give up slippage. You do give up extra slippage. So one additional setting that you can use in this analysis that I did not do was they have actually a slippage number. So you can come in here and you can, I went ahead and I paused the video and I did this, and I said slippage 1. And in TradeStation we're used to looking at $12.50 per side or $25 round turn, or different numbers depending on the market and your commission rate. We typically put in a dollar amount. This is a tick size amount, slippage of 1 tick. So every strategy that can get 1 tick, you will in any fill that could get 1 tick means you get it. So if you have a stop order at the low of a bar, it will not register that 1 tick of slippage. But if that low is below your stop price, then it will register that 1 tick of slippage. And so it's more accurate in terms of predicting slippage by not giving you slippage in situations where those orders are at the low of the bar. And that is an assumption, though, because it is possible that your order could have been the one order that caused that additional slippage. So it's a static environment where you're not looking at the order book. You can't possibly know, even if you had order book data, where your order would have been in that line of order book data. So that slippage assumes that your order would not have caused a lower price on those few trades where your stop order or market order was at the low for a sell or at the high for a buy. And so this does calculate slippage, and we put in 1 tick of slippage on orders that could have received slippage because they are not at the low for the sells or the highs for the buys. And so let's look at the performance summary for that, and that'll be one additional viewpoint. You cannot add, there's no place to add commission in here, so you have to think of that manually. So let's take a look at what the results would have been. This is with the price trading through the limit, and so now we're comparing the pessimistic view with slippage. And so you have 42.55 with no slippage on the stop or market orders, and requiring the limits and profit targets to be trade through the price. And on this report, you then also still require the limit orders for the entry and profit targets to trade through the price. You also add 1 additional tick of slippage for orders that are not at the lows for the sells or the highs for the buys, and you get 36.56 average trade profit. And when you add $5 commission, you're at 31.56. We said 29. We took out 13.50 and got 29 here. So that was a pessimistic view. Now you're at 36.56 minus 5. We just use that as a number. You might have lower or higher commissions. And you see the analysis here. Here is the equity curve. You say there's red at the start, and so I'm going back as far as I can with Kinetic. If you started at this, if you put the start date here, it would show red. If you put the start date here, you'd see red. You'd see red to here. If you put the start date here, you'd see red. So it just shows red when it's below 0. And there's a lot of places you could start this where it would start out with red, or you'd see red at the beginning. But I went back as far as I could in Kinetic, the data feed, in NinjaTrader 8, and that generates the first trade on 7/19/2006. And so that is a deep analysis of slippage and commission around Cobra 3 and NinjaTrader 8 on the E-mini S&P.